We are currently living through the biggest inflation crisis since the 1980s. Back then, inflation rates were going as high as 14%. However, for the last 40 years, inflation has been on a downward trend and hasn't neared the peaks of the 80s. That was, of course, until 2021, when inflation rates started to skyrocket. Now we're all feeling the pinch of higher prices. You're paying 10% more for food today than you were a year ago, 32% more for energy, and 10% more for airline travel. Add in spiking rental costs, rising house prices, and the largest retirement crisis in modern history, and yeah, we've got some big challenges. Because this crisis is deeply affecting each and every one of us, I thought we could discuss why this crisis exists, what's being done to solve it, and how you can best prepare yourself for the coming months. Unfortunately, you don't have a lot of time to prepare. Global central banks are planning to make changes which haven't been seen for decades, which we'll discuss. So there's lots of uncertainty for the future, making it even more important to be prepared. So how bad is the inflation crisis? $100 today would only buy you $58 worth of groceries in 2000. In other words, the purchasing power of the dollar has fallen by 42% in just 20 years. How has this happened? Well, the problem started during the Great Recession between 07 and 09. The collapse of the US housing market had wreaked havoc globally. In order to keep the economy afloat, the US central bank, better known as the Federal Reserve, decided to use a tool called quantitative easing, or QE. For lack of a better explanation, central banks have the ability to print money out of thin air. Quantitative easing involves central banks using this money to buy lots of financial assets, like government bonds and mortgage-backed securities. Without going into too much detail, quantitative easing makes borrowing money cheaper, therefore resulting in more money circulating in the economy, which encourages spending. It also has the secondary effect of increasing the amount of money invested in the stock market, but more on that later. There have been 4 times since 2008 where quantitative easing has been used by the Fed. Here, and here. Every time quantitative easing is used, it devalues the dollar, because the Fed printing new dollars devalues dollars already in existence. As we can clearly see from the graph, the Fed printed an insane amount of money in response to the global pandemic. To put this into context, in August 2008, the Fed had about $900 billion worth of assets on its balance sheet. As of recording this video, that figure is now nearly $9 trillion, a tenfold increase. The bottom line is that the Fed has dramatically increased the number of dollars in the economy via quantitative easing since 2008, and this has led to significant demand for goods and services. The problem is that global supply chains are broken. The pandemic puts significant strain on existing supply chains, with one statistic noting that the average container now spends 20% more time in the system. We had surging levels of consumer demand at the same time as strict COVID protocols which restricted supply. So what happens when you have too many dollars chasing too few goods? Economics 101 tells us that prices increase, and that's exactly where our inflation is coming from today. To make matters worse, the Russian invasion of Ukraine, as well as continued strict testing procedures in China, are worsening the already bad situation. You've no doubt felt the effects of surging commodity prices, and this is largely due to key supply channels being severed because of the war. But what's really important to understand is that it's not just broken supply chains which are driving higher prices. It's the demand for goods and services which is causing pressure. So that brings us on to what's being done to solve the inflation crisis. First of all, the Federal Reserve stopped their quantitative easing program in March. This was them pulling the plug on the money printer, which has been running for the past 2 years, and the effects of this are already being felt. The 10-year US Treasury yield is about to hit 3%, a level which it hasn't reached since 2018. This is significant because the 10-year yield is used as a benchmark when setting interest rates for mortgages and other loans. The higher the yield, the higher borrowing costs become. I mentioned at the beginning that global central banks are planning to make changes which haven't been seen for decades. These changes will come in the form of rising interest rates. The federal funds effective rate, which is the interest rate that banks charge each other for borrowing or lending cash, has been virtually zero since March 2020. 2020. But last month, the Fed increased this rate by 0.25%, the first increase in 3 years. And now we're looking at an additional increase of 0.5% in May, which would be the biggest increase in over 20 years. These increases will likely continue throughout the rest of 2022. The goal here is to increase the overall cost of borrowing, therefore reducing the amount of cash circulating in the economy, therefore reducing demand for goods and services. This is a bit of a double-edged sword. On the one hand, inflation definitely needs to be addressed, as the cost of living is quickly spiraling out of control. However, on the other hand, housing affordability will only worsen with these changes. 30-year fixed-rate mortgage rates in the US have predictably started to skyrocket to the highest levels in 11 years with the changes introduced by the Fed. And with house prices having increased by nearly 20% in 1 year, home ownership is looking more and more like a pipe dream for the younger generations. The question is whether or not the Fed's policy changes will result in a recession. Honestly, we don't know what the full impact of the changes will be, but there definitely will be consequences, as is the nature of central banking. Increasing the cost of borrowing helps the Fed to slow demand, but the consequences of that are slower economic growth and likely higher unemployment. But what the Fed really wants to avoid is stagflation. Stagflation is a nasty combination of high prices, high unemployment, and low economic output. Commentators like Ray Dalio believe that a period of stagflation is coming for the US, just like how it did in the 1970s. Idea being that the Fed's interest rate changes won't be enough to curb inflation, but will be enough to slow economic growth and increase unemployment. Needless to say, the inflation crisis is pretty complicated, and there's lots of uncertainties which make it difficult to speculate what way the coming months are going to go. The jobs market is also playing an important role in the inflation we're seeing. In February, there were 11.3 million job openings in the US. Employees have massive bargaining power right now, primarily due to the Great Resignation and the cry out for workers. We know that people are changing jobs and getting paid much higher salaries to combat inflation. The issue is that inflation is a self-fulfilling prophecy. Paying your workers more money to account for inflation in turn causes inflation, as higher business costs are passed on to the customers, who are now paying higher prices. Likewise, if consumers are expecting prices to be higher in the future, they'll simply buy more goods today, which in turn increases future prices. The inflation crisis has challenged the sustainability of our current monetary systems and raises the question of whether there's potential in moving to a digital currency. Joe Biden recently signed an executive order on cryptocurrencies, where he asked the Justice Department and the Treasury to investigate the potential for creating a central bank digital currency, or CBDC. And we know that this is also something that the Fed has looked into. A CBDC would act as a digital dollar, issued and backed by the Fed. Most recently, US Treasury Secretary Janet Yellen went on record saying that a CBDC could indeed become a trusted form of money comparable to physical cash. But she also noted that such change would take many years to come into play due to the complexities of the process. Frankly, it's still too early to know what role digital currencies will play in our societies in the future. But what's most interesting is how cryptocurrencies and CBDCs will coexist alongside each other, with cryptos being decentralized and CBDCs still remaining centralized. You might be wondering how the inflation crisis will impact your investments going forward and what you should be doing to protect yourself. The reality is that rising interest rates and fading support from central banks is going to hurt the stock market. The S&P 500 is down almost 10% since the end of March. That's really for 3 reasons. The first reason is how stock prices are calculated. The price of any stock on the stock market is calculated as the market's expectations for future cash flows discounted back to the present day. The higher interest rates go, the larger the discount will be, which results in a fall in stock prices. Plus, higher interest rates can slow output for companies, translating into lower future revenues and earnings. The second reason is that there's less money going into the market. The reason why interest rates rise in the first place is to tighten the supply of money. So naturally, there will be less money available to invest in stocks. The third Another reason is that interest rates on bonds are increasing, and because bonds are historically less risky investments than stocks, investors exit the stock market in favor of the higher returns offered by bonds. The best thing you can be doing right now is to avoid overspending on non-value adding items. When the cost of living is going up, it's the exact same thing as getting a pay cut. So you need to treat your spending as if you had gotten a pay cut. Prioritize the necessary expenses and do your absolute best to live within your means and save and invest for the long term. Yes, it's never been more important to have an emergency fund, but it's equally never been more important to be on top of your investments for the future. This is the name of the game when it comes to long-term investing. You have to be able to adapt to both the good times and the bad times. And it's always the same. In 10-15 years, people look back and say, oh, I wish I hadn't sold, or oh, I wish I kept investing during that time. Remember, if you missed the best 10 days of the stock market over the last 20 years, your return on investment over that time period will be cut in half. In other words, you have to be in it to win it. Just remember that no matter what you choose to do with your cash, so long as it's sitting in a bank account and so long as inflation is high, you're losing money. So that just about wraps up the inflation crisis. And yeah, it's a tricky situation. Look, it's very easy to get caught up in the gloom and doom of everything when in reality, the right thing to do is to just be cost conscious and to always remember the basics. And if you want to learn more about those basics, make sure to check out the other videos on my channel. I have videos covering virtually every personal finance topic. And don't forget to check back in soon because I will be making more videos on this topic as the situation develops. If you've any questions on anything I covered in this video, just leave them in the comment section. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.